Have you ever looked at currency exchange rates and just wondered, why? Why are they always moving? One day your dollar buys more on vacation, the next day it buys less. Well, it turns out the answer is hidden in every single thing we buy from another country. So let's get into it. This is really the big question, isn't it? What actually makes the US dollar strong or the Japanese yen weak? You hear these terms all the time, but it's not some kind of magic. The secret is basically a giant worldwide accounting project that's constantly tracking where all the money is going.
And to get our heads around that, we need to talk about something called the balance of payments. Now I know, that sounds super technical and maybe a little boring, but stick with me. At its core, it's really just the story of how one country does business with the rest of the world, one purchase at a time.
Okay, so what is the balance of payments, or BOP for short? The easiest way to think about it is like a country's financial scorecard. It's this huge, detailed record of every single dollar, euro, or yen that flows in or out of a country, whether it's for buying a t-shirt or investing in a company. Let's break this down with a super simple example. Say someone sitting in a cafe in Paris decides they want to buy something from an American website. Well, that US company wants to get paid in US dollars, right? Not euros. So the French buyer has to take their euros, sell them, and buy US dollars to complete the purchase. In that tiny little exchange, it gets logged in the US balance of payments. Seems pretty small, doesn't it? But now imagine that happening millions and millions of times every single day.
And that right there, that's the whole game. That one seemingly insignificant action, when multiplied across the entire globe for every product, every service, every investment, it becomes this massive, powerful engine that literally drives the value of currencies up and down.
Which brings us to something we can all understand: basic supply and demand. You can picture it as this giant, constant, global tug of war for every currency out there. And the balance of payments is what tells us which side is pulling the hardest at any given moment.
So here's how it plays out. Let's say lots of people all over the world want to buy American-made goods, or maybe they want to invest in the US stock market. To do any of that, what do they need? They need US dollars. This creates a huge demand for the dollar. And just like with anything else, when demand goes up, the price goes up. That puts upward pressure on the dollar's value, making it stronger. All of a sudden, it costs someone in Europe or Japan more of their money to buy a single US dollar.
And, the source material really hits the nail on the head with this. It says, as more US dollars are demanded, upward pressure is placed on the price of US dollars. It's that direct, simple connection between what the world wants from a country and how much that country's money is worth. But of course, with economics, it's never quite that simple, is it? The balance of payments is a huge, huge piece of this puzzle for sure, but it's not the only piece.
You also have to factor in things like a country's monetary policy. For instance, a central bank could decide to print more money. That's called an expansionary policy. That increases the supply of its own currency floating around. So even if demand is super high, this new flood of cash can work in the opposite direction, kind of canceling out some of that upward pressure and pulling the currency's value back down.
Now, there's a really important catch here. This whole system we've been talking about, this whole tug of war of supply and demand, it only works under a specific set of rules. To really get it, we need to look at the alternative.
See, today, most major economies use what's called a floating rate system. That just means the currency's price is allowed to float up and down based on market forces, which is why the balance of payments matters so much. But the other option is a fixed rate system. That's where a government or central bank steps in and basically says, our currency is worth this much, period. They actively buy and sell currency to keep the price locked. In that world, the balance of payments doesn't really affect the exchange rate directly.
And there's a quick bit of history here that's actually pretty important. For a long time after World War II, the world was on a fixed-rate system called Bretton Woods. Most currencies were pegged to the US dollar. But that all fell apart in the 1970s. Ever since then, we've mostly been living in a floating-rate world, which is exactly why watching a country's balance of payments has become so incredibly important. Okay, so we've gone from a single online purchase all the way to the history of the global monetary system. That's a lot, so let's just boil this all down and make sure we've got the key takeaways straight.
All right, here's what you really need to remember. First, the balance of payments is that master scorecard for a country's money flow. Second, because we live in a floating rate world, that scorecard has a direct impact on a currency's value through supply and demand. Third, if the world wants a country's stuff, its currency gets stronger. Simple as that. But also remember, other things like monetary policy have a say too. And finally, none of this supply and demand stuff matters for the exchange rate in a fixed-rate system.
And all of this leaves us with a really fascinating question to chew on. As we dive deeper into a world of digital currencies, crypto, and borderless money, will this old idea of a national balance of payments even make sense anymore? Will this scorecard that has defined currency values for decades still be the engine that moves the market? That's something to think about. Thanks so much for listening.